Good morning, everyone, and thank you for joining us. My name is Michelle Waitley, and I'm the Specialised Business Bank Executive for Commercial Real Estate at NAB. As we begin today, I'd like to acknowledge the traditional owners of the lands on which we meet. I'd like to acknowledge the Boonwurrung people of the Kulin Nation as the traditional custodians of the land on which I am joining you from in Melbourne, and I'd like to pay my respects to all elders past, present and emerging. So welcome to our first property market webinar for 2025. We saw the RBA reduce rates yesterday, so our economic update today is opportune. We'll provide you with an economic review and outlook for 2025. We'll unpack the RBA decision. We'll discuss the potential impacts on the commercial real estate market and also identify trends and themes to watch for this year. Joining us today is a regular speaker, Taylor Nugent, who is a senior economist within the Global Markets Research team here at NAB. Taylor provides economic and market insights for our clients with a focus on the Australian economy, labour markets and inflation. He's also a regular contributor to the NAB Morning Call podcast. Taylor studied economics at the Australian National University and began his career at the Reserve Bank of Australia, where he worked as an economist and financial markets analyst. We're also really pleased to be joined again by Ben Martin-Henry. Ben is Head of Private Assets Research and Senior Strategic Advisor for the Pacific region at MSCI, and is responsible for producing action leadership covering both the major property sectors and newly emerging ones. Ben has over 15 years of experience in Australia and the UK across investment analysis, research, strategy, and product development in the property sector. Ben began his career at IPD in London, where he worked predominantly in research. Upon transferring to the Sydney office, Ben took on the role of lead client consultant for the Asia Pacific region. He then moved to CBRE, where he was head of capital markets, office and BTR within CBRE research for over 5 years, before moving to RCA as head of analytics for the Pacific region, which MSCI subsequently acquired in September 21. Welcome, Taylor and Ben. We're hearing from our customers that business confidence has improved since the new year, and we're also seeing more activity in the property market. As Australia's largest business bank, I want to assure you that we're open for business. We have a very experienced property finance team, and with our deep understanding of the market, we look forward to working with you as your finance partners in 2025. We'll have time for questions after the formal presentations, so please use the Q&A function at the bottom of your screen and we'll get to as many as possible. We're also recording this session and we will share it with you afterwards. On that note, I'm going to hand over to our first speaker, Taylor.
Thanks very much, Michelle, and good morning, everybody. It's an opportune time to be speaking with you all and giving you this update. As Michelle said, we saw the RBA yesterday. They did deliver that cut in February, talk through how they've framed it, what their forecasts are, what our forecasts are, and how we think things are likely to evolve over this year. There's also a lot going on in the global backdrop at the moment. So it is still a highly uncertain environment. We're kind of hoping that here in 2025, 5 years on from the start of the pandemic, some of this elevated macro uncertainty in the backdrop may be starting to resolve. The problem set is different. Some of the unknowns certainly look different than they did in 2020 and 2021, but it's still certainly a very uncertain environment as we look forward. I think, while we're here to talk about Australia, the domestic outlook, the RBA, what it means for rates, it's hard to, do any kind of presentation like this at the moment without first touching on the Trump presidency, the White House, US policy uncertainty, and how we're thinking about that, both from a global perspective and also that those channels through into Australia, and whether this policy uncertainty is going to impact Australia and the domestic outlook. I think, the key thing when we look from a global perspective, tariffs, trade policy, that's where the uncertainty is most elevated and most impactful on global growth, global supply chains, and global inflation. Certainly, if we think about the US specifically, you've got, tax and spend policy, you've got the deregulation agenda, you've got policies to do with migration that all have large macro impacts as well. But, thinking about it sitting here in Australia, we're looking at tariffs as the most obvious source of uncertainty that could flow through to the Australian backdrop. I think that, it's worth setting up the stakes. What is mooted, what kind of policies have been put in place, and how big a change is this from what we've seen in the past. We know in the first Trump presidency in 2018, there was an increase in tariffs. You can see on that right-hand chart there, though, the kind of magnitudes were much smaller than what we're already talking about in the second Trump presidency. We saw average UF tariff rates go from something like 1.5% to something like 2.5%. A lot of that was largely sustained. The types of policies that have been mooted so far, and some of them already put in place, are a real step shift from what we saw during the first Trump presidency and a much, much more meaningful barrier to trade. How far these go, how sustained are they, how broad-based are they? These are all kind of known unknowns in the backdrop that policymakers and business people and us as analysts are going to have to respond to as and when these uncertainties start to get resolved. But as you can see there, even the 10% tariffs that have already been put in place on China, the 25% tariffs on Canada and Mexico that are to come into effect in early March, unless they're extended again, would be a very meaningful lift in average tariff rates and an increase in barriers to trade. That matters a lot from the US perspective. Increasing trade barriers, it weighs on growth, it adds to inflation pressures, but probably only in a way that is temporary, more of a one-off price shock. So, it doesn't necessarily mean the Federal Reserve needs to raise interest rates in response. But, here in Australia, what are the impacts? I think the first point to note is that from the US perspective, trade with Australia is firstly small and secondly pretty uncontroversial. The US, we import more from the US than the US imports from us, and total trade is reasonably small. If we think about total US goods imports from Australia, all of Mexico, Canada, China, the EU are all about 25 times or more larger than the total amount of imports that the US gets from Australia. So we don't expect Australia to be kind of a particular focus of country-specific tariffs, but that doesn't mean that we won't kind of get caught up in good-specific tariffs or any universal tariffs that do come through. The big impacts for Australia, though, are, even from our perspective, the US is not our largest trading partner by any stretch. Our total goods exports to the US are a little less than 1% of GDP. They're about 4% of our total goods exports. They're dwarfed by our trading relationships through Asia. And so when we think about our total exports to the US, they're a bit over $30 billion a year. You look at China, it's over $200 billion a year. You look at Asia as a whole, it's over $500 billion a year. And so in terms of mapping these sorts of impacts through to Australia, while certainly for specific industries, specific sectors, there could be some disruptions if there are tariffs put on Australia's direct trading relationships with the US. It is that indirect impact through global growth, through Asian growth, through Chinese growth that we're likely to see, the most impact from. On that front as well, another kind of saving grace, I guess, when we think about the Australian perspective is that we have the currency and we have the currency as a shock absorber. So if you have direct exposure to the currency, this matters. We're seeing the Australian dollar, be responsive as we've seen tariff announcements. We've seen it much weaker than it was heading into the Trump presidency, in large part responding to these global and Asian and Chinese growth risks from an increase in trade barriers from the US. And we think it will continue to be sensitive to trade policy going forward as well. But a big point here is when we think about the domestic implications, when we think about growth locally, when we think about the local property market, when we think about the RBA, an Aussie that is lower than it would have been otherwise in a downside scenario for global growth and tariff protectionism is something that largely insulates, not completely, but certainly goes some way to insulate the domestic economy from some of those impacts and kind of, mitigates, I guess, those kind of domestic growth implications of this global, highly uncertain global environment that we're talking about. So having said that, what are these domestic considerations? If these things, matter at the margin to the extent that they weigh on Chinese Asian growth and there isn't a full-throated fiscal response from Chinese authorities to counterbalance it, then, there could be some negative impact on growth. But we think this is, not going to be the key driver of what's happening domestically. It's going to be the domestic cycle that is most important. And that brings us pretty neatly into where are we in that cycle. And where we are at the moment is that we have gone through a period of rebalancing for a couple of years now. I've got here GDP per capita, Australia highlighted there in red. You know, it has been going backwards for quite some time, certainly through 2024 and through 2023. But the context here was a position of strength. We had a rebound out of the pandemic impacts that was much more than complete and compared very favorably across countries. And we've had, a slower GDP per capita growth experience since then. But even now, even after that couple of years of fairly weak growth outcomes, the level of GDP per capita relative to pre-pandemic, it still compares pretty favorably when you look across countries, and it's still over 2.5 percentage points higher than what it was all the way back in 2019. Masking some of this slowdown in growth on a per capita basis, when we think about the broader capacity pressures, when we think about the demand picture facing businesses, has been that a lot of it has been masked by the strength in population growth. Here as well, there is, I guess, in some sense, a rebalancing that is nearing completion. We saw population growth pick up. It was rapid. The 15 plus population was growing near 3% for a while there. It's still growing at elevated levels relative to prior to the pandemic. But it's important to remember that a lot of what's driving this growth cycle is a period of catch up. We had closed borders during the pandemic period. We had very, very slow growth. We had people who are here on temporary visas, working holiday makers, international students especially, who just weren't in the country. Those people have come back, and they've come back very, very quickly. And that's what's driven this rapid acceleration in population growth that we've seen. That kind of rebuild, if you like, of that segment of the population is now largely complete. And we're seeing population growth, continuing to slow back down towards normal levels. And so we expect that to continue. From a growth perspective, that means that we need a handover. We've had growth being held up by just the number of people in the country, even as there has been some softness and some adjustment coming through on the. When we look forward, we think growth is picking up. I'll get to that in more detail in a second, but we also think that the drivers are shifting, less from that sheer number of people in the country that's driving growth and more towards a bit of a recovery in that per capita spend piece. A big part of that is that the household income picture is changing. In Australia, I mentioned before that the level of activity actually doesn't compare unfavorably to other countries, even if recent growth performance has been weak. But Australian households have suffered a pretty material real income squeeze over the past couple of years. The big driver of that has been inflation. Inflation has been much too high, and it's been rapidly outpacing wages growth. Another has been the drag from the tax take, as real income taxes have been going up in a higher nominal growth environment. And we also have obviously the RBA easing cycle playing into this. But when we think about the household sector as a whole, that kind of interest payable piece of the puzzle is third on net to the price impact and the tax impact. When we think about those dynamics, those headwinds to growth, those headwinds for households have turned through the back half of 2024, and we're already seeing that translate through in an increase in real income growth. So inflation has moderated much more quickly than wages growth has. If we think back to the 1st of July last year, we had the stage 3 tax cuts come through. They're worth 1 to 1.5% of disposable income for households. The RBA only delivered a first cut yesterday, but certainly rates had been on hold for a long time. And so that ratcheting higher in mortgage servicing costs, it was a big drag on households earlier in the cycle, hasn't been a drag to the same extent recently. And so all of these things mean that those headwinds facing households have turned around. And we're now kind of watching to assess just how much and how forcefully is this translating through into a pickup in growth and a pickup in consumption, which we expect to be a big. What we can see in our internal data into the end of last year is that this looks to be coming through. It does look like consumption ended 2024 on a much, much firmer footing than what we saw early in mid-2024. There's some open questions still about how much that is sustained through into early 2025. Broadly, we do think that growth is picking up. We think growth will rise to a bit over 2% through 2025, something like 2.25% through 2026 as well. I've got our forecast here on the left relative to the RBA, and you can see that while the RBA was disappointed in growth outcomes in Q3 relative to its November forecasts, the forecasts that they published yesterday are pretty much in line with our own forecast for GDP. They also expect this pickup in growth to be coming through. Similar story on the unemployment rate. And I think what's interesting on the labor market is that it has been so resilient in the face of this weaker growth outcomes that I was talking about recently. We'll touch on that a little bit more in a second. But here as well, the RBA's unemployment rate has been revised down quite meaningfully from what they were expecting in November. They now see unemployment peaking something like 4.2% and kind of sustaining there through the forecast horizon. And as you can see, that's pretty similar to what we're expecting on unemployment as well. The obvious question here is, well, if growth is still picking up and the labor market is more resilient and has been stronger than the RBA was anticipating, how have they found room to cut? Why did they cut rates yesterday? The answer to that really comes down to the inflation trajectory. And so even though growth is still expected to pick up, even though the labor market has stayed more resilient than the RBA had been expecting late last year, the inflation backdrop has given them space to start the process of gradually easing policy away from where they got to during the tightening cycle. Inflation has moderated. We've seen certainly the housing components be very helpful on that. As you can see here, the RBA's forecasts, inflation in the fourth quarter, it came in well below what the RBA was expecting in November. That's the key surprise that got them over the line to a cut yesterday. But when we look forward, from our perspective, the RBA is still fairly cautious on the inflation outlook. Our central case certainly expects a bit more good news on inflation through the first half of 2025 than the RBA felt comfortable putting into their forecast in February. And so when we look at the communication from Michelle Bullock yesterday, the post-meeting statement from the board, there was a real kind of hawkish tilt to it, if you like. They had seen enough to deliver an initial cut in February, but they didn't want to commit to what the path forward looks like. They were talking about, still being concerned about upside risk to inflation and risk that disinflation progress stalls. And that's why we saw this pushback against market pricing that embedded a couple more cuts through the course of this year. When we, confront that with our forecasts, we agree growth looks like it's picking up. We agree the labor market doesn't look like it's going to deteriorate too much further. I guess we're a little bit more optimistic that this won't be as inflationary a backdrop as the RBA imagines. And so we're thinking that gives them a bit more space to continue to move lower through the course of 2025. On the labor market, just a little bit more detail here. I mentioned it's been resilient. Employment growth has remained robust. We've got an unemployment rate at 4%. That is, about where it was a year ago. We really haven't seen that much cooling in the labor market. We've also got measures of underutilization, so people who would like to work more hours than they currently are at very low levels as well. And so, one of the big risks here, when we think about our base case for an RBA that can continue to move lower, is that the labor market isn't just stable and it's a good news story, but it might actually be retightening alongside this pickup in growth. So, that's not something that's in our base case, but that could be kind of a good news story from a growth and economic perspective that is a bad news story if you're expecting the RBA to deliver on lower rates. So that's, one risk that's out there in the backdrop. I think, with the labor market where it is, labor is still a constraint for many businesses. We can see that in our business survey. But importantly, even though aggregate unemployment indicators have remained low, the job finding experience for employees or potential employees has gotten a bit harder. It's kind of a lower churn labor market. And so while these aggregate indicators still suggest a labor market that is healthy, there's some other indicators in the backdrop that suggest maybe it's not quite as tight, maybe it's not quite as wage inflationary, maybe it's a bit more imbalanced from an employer versus employee perspective than what we saw a year, 18 months ago. And so that's, one other thing that is giving us some comfort that it's not going to translate through into ongoing persistent inflation pressure in a way that would derail the RBA. Even though, were it to be retightening, that would certainly be something that would give them pause. The other piece of the puzzle here is, what's driving this improvement in inflation and what we saw at the end of last year and what we expect looking forward. Certainly, we can see in our NAB business survey that cost pressures are still elevated relative to history, but they're heading in the right direction. They've kind of continued to move lower in late 2024. So we've seen kind of in a lot of industries in construction, especially this kind of cycle of where these price pressures are coming from. It was import costs, it was global supply chain disruptions initially, then it was more domestic pressures as well. Kind of a handover from it was labor cost pressures that were moving to the fore. And certainly for a lot of services businesses, it's kind of evolved recently towards overheads that have been the more sticky piece of the cost structure for businesses. So these are things like, electricity costs, insurance, commercial rents. These sorts of slower moving pieces of the cost space have been driving some of this residual pressure. At the same time as we've seen kind of continued progress on the cost pressure side of the picture, we've also seen this slower period of growth mean that it's a more challenging environment for businesses to pass costs on downstream. And so, what we've seen is that when we talk to businesses in our business survey and ask them, what is a constraint on your output? Why aren't you growing? We've seen that evolve from we don't have the materials to do the work to we can't get the right people to do the work. That's still a constraint on many businesses. But increasingly, people are saying we don't have the orders to expand into. The demand's just not there. And so that's an environment which firms have less pricing power. It's a more challenging profitability environment. And it's an environment that some of these residual cost pressures that are still kicking around in the backdrop aren't finding their way as readily into end consumer prices, which is where the RBA is looking. The other big piece of this is that, what has been a surprise to the RBA and kind of helped them see that some of this upside risk that they had imagined was there in the inflation backdrop might be fading is improvements on construction cost inflation and through housing more broadly. So while we've seen that kind of initial imported goods drivers of inflation fade, we've seen the trade exposed piece of the puzzle. It's now broadly benign. It's not a big contributor to inflation. Might kick up a little bit with the Aussie being lower through early this year, but we don't think it's going to derail progress. We've got these domestic service cost pressures that are evolving like you would expect. They got elevated. They're still a little bit elevated, but we're making gradual progress as we've seen rebalancing, and we expect that to continue. What's moved more quickly is that housing construction costs went from running about 20% annualized. They slowed to about 5% annualized. They've recently slowed down even further. And so that's the largest component of the inflation basket. And that's been very helpful in kind of making the outlook for inflation look a little bit better. This isn't to say that, those costs are falling. It's just that they aren't growing at anything like the pace that they were, through the early part of 2024, and certainly nothing like what we saw through 2022. It's more about these pressures that are still there are sustaining costs at elevated levels rather than driving further price growth every single quarter. So how do we map that into what it means for the RBA? I said there, we're more optimistic in our base case that this good news story of a pickup in growth, the labor market that is healthy, but it's a backdrop that we don't expect to be particularly inflationary. And that's an environment in which we think that the RBA can continue to cut gradually. What that looks like is we expect another 75 basis points this year, next cut coming in May, and then one per quarter after that. And then we expect one final cut out there in 2026 to bring the cash rate to an ultimate terminal rate of 3.1%. What I would say there is, if anybody is still imagining that policy rates are getting back to where we were pre-pandemic, 1.5%, something like that, we think something would have to go wrong. We would have to see much, much weaker growth outcomes. We would have to see a meaningful negative surprise to our growth forecasts for the RBA to be moving rates that low. And so, policy rates move that low in a bad news scenario if the economy is much weaker than we're imagining. In a world in which our broad story of a soft landing, growth that's picking up, the worst is behind us, the unemployment rate is reasonably healthy and remains that way, it's fair to say that, the risks probably do skew to the RBA delivering on these cuts a little bit later than we expect and maybe ultimately not moving quite as far as we expect. But certainly, if we're right that the labour market is not as inflationary as the RBA fears and inflation comes in over the course of the next year in a way that continues to build that RBA's confidence, our base case, our central forecast at the moment is still that policy rates can continue to move lower and ultimately 100 basis points lower from here, even if the RBA is moving gradually and cutting to support good outcomes to sustain this pickup in growth that we're expecting because they're not as worried on inflation rather than responding aggressively like we've seen from the RBNZ, like we've seen from the Bank of Canada in order to kind of get ahead of emerging weakness in the economy. That's not what we expect in our forecasts. The other thing to note there as well is that, while market pricing is for a slightly shallower cutting cycle than we have in our base case at the moment, given where market pricing is today. It's still the case that if we look further out in the curve, if we look at 3-year, 5-year swap rates, certainly out as far as 10-year, these have been below policy rates through much of this cycle. That's unusual. We don't expect them to stay that way. And so as and when the RBA continues to deliver on this cutting cycle that we expect, we don't expect that to translate through one for one further out the curve. So we expect to see some steepening as the RBA moves policy rates lower. And so we don't think that this cutting cycle that could extend another 100 basis points from here is going to translate through into anything like that kind of fall lower once you look further out in the curve. So with that, I will stop for a moment. I'm going to pass on to Ben, and then we'll have some time for some questions at the end.
Taylor, let's bring up my slides. There we go. Very interesting. Yeah, good news on interest rate cuts, and it will have an impact on commercial real estate, most definitely. Thanks again, NAB, for having me. It's always good to do this, particularly when I have more positive news to spread, which is always nice. But it's been a rarity over the last couple of years. But if we look at our direct property index, it's pretty good news. We call it total return pretty much flat, which is a significant change in the last couple of years, which is, again, very welcome news. We still do have a fair bit of capital value decline within the index. That is, the properties losing their value, but it does seem to have slowed down quite considerably. Now, the important point on this chart in particular is, despite this positive news, I don't think we're going to see a GFC type recovery where everything went down and everything came back up again quite quickly. I think it's going to be quite varied, and I think the actual recovery profile is going to look...
Sorry, Ben, we're all just having a little bit of trouble hearing you. So I might get you to just reboot for a second, and I might just ask Taylor a quick question while you're doing that. So Taylor, one of the questions that's here is about the business labour cost pressures trending down, but that the labour market's stable. So maybe if you can just talk us through, that as a contradiction.
Certainly. Yeah. So I think, a key point is that there's a lot more to the labour market than just the unemployment rate. And so what we saw during the pandemic and the pandemic recovery was that vacancies shot up to very, very elevated levels. Churn between jobs was very high. You had people quitting jobs, you had people leaving to go to new employment opportunities, and you had people who were finding work that had, a much more kind of favorable, they were facing much more favorable conditions. They could, shop around job offers, they could be negotiating salaries, and so these sorts of things were putting extra pressure on wages over and above an unemployment rate that was low. And so some of those drivers have started to fade, and so we've seen more rebalancing in the labour market, I suppose, than you might expect if you just look at an unemployment rate that was around 3.5 and now is around 4. There's been more changes than that in the background, and so that's why we're seeing that not translate through into the same labour cost pressures that we saw in 2022 and 2023. What I would say though is that once again, baselines matter. When I say wages growth is cool, it's still running well ahead of what people got used to prior to the pandemic. And so that's where it's still a healthy labour market. Wages growth is outpacing inflation, and it's much stronger than it was in 2018, 2019. Those pressures have just cooled a bit from what we saw a couple of years ago.
Great. Thanks, Taylor. Ben, let's see how you sound.
That's a bit better.
A little bit.
A little bit better? Not much better.
No, I think that's okay.
Okay. Apologies for that. As I was saying, a lot more positive news for the performance of commercial real estate. And a big reason for that is we have seen a big surge in transactions. We're seeing a lot more investors buying into the market. So last year we saw around $45 billion worth of commercial property transactions. That's up around 50%. Caveat to that is a massive chunk of that, around 22%, did come from that AirTrunk deal. That was Blackstone and CPPIB picking up AirTrunk's data centers. But
even if we exclude that particular deal from the transaction volumes, we're still looking at around a 15% increase on last year. So again, definitely positive signs. Yes, last year was it was a very slow year, but as I said earlier, I don't think this is going to be a sharp recovery. I think we're starting to see green shoots, positive signs, but I don't expect to see a very sharp bounce back. And we're kind of spread not exactly evenly across the market. So this is just looking at top market segments where we're seeing most of the capital allocated. And there's a couple of concerning points here. Sydney Industrial is number one. Again, that's heavily driven by that air trunk deal. But I do have a lot of concerns around the Melbourne office market. We only saw around $1.4 billion worth of transactions in the Melbourne office market last year. That's 3% lower than the year before. And 2023 was also a very, very low year for Melbourne office transactions. We're just not seeing investor appetite really come back for that Melbourne office sector yet. It is a little bit of a concern. Not a lot of investors that I speak to are actively looking at Melbourne offices. There are a lot of offices on the market or off market as well, but we're still seeing very little appetite for that. One very positive sign in here, though, is Adelaide retail. So Adelaide retail rarely cracks the top 10 for allocations. Normally it's around the low 20s, but we saw almost $1 billion worth of investment into the Adelaide retail sector as some of our large institutions picked up larger shopping centres, some smaller ones as well. So really, it is a nice change, and it does show that there's a lot of appetite for retail investments at the moment, which is a theme throughout my presentation, and it definitely is a bit of a structural change for that retail sector as well, which has gone through some pretty tough times. Now, just looking at again a bit more detail in the sectors. Full disclosure, data centers sit under industrial for us. But even if we took out that air trunk deal or all data center deals from the industrial sector, it still was the number one traded sector last year, and it has been for the last couple of years. The office sector has bounced back, nearly $10 billion worth of transactions. That is well below 10-year averages. But again, we're talking at turning points here, and this is, again, positive news for that office sector. I think values have adjusted enough in core markets like Perth and Brisbane and Sydney that you're starting to see investors go back into those markets because I think there's a bit more relative value there. And retail has been doing extremely well. I'll skip over retail because I'll talk about it in a bit more depth later on. Now back to performance. So this is based on valuations. Look, all sectors are improving. We still see a negative total return and negative capital growth for most sectors, but we're on the way up. Overall, the index returned a positive total return in the quarter, and it really was driven by that retail sector. Industrial's been doing extremely well for the last couple of years, and honestly, it saw a little bit of capital loss sort of last year, but by and large, it's been pretty solid. And we've also seen positive quarterly capital growth for industrial in Q4. Now, healthcare is a bit of an interesting one. I'm still not entirely sure what's going on with the healthcare sector. It was running at levels akin to the industrial sector performance, sort of 25, 26, 27% capital growth. But it's not bouncing back like all the other sectors. I mean, even the office sector has that sharp straight line up in Q4. We're not seeing that with healthcare. It's kind of ticking along the bottom. So I do have a couple of concerns about what's actually going on in the healthcare sector, and if the issues, with HealthScope, for example, if that's really impacting valuations on these assets. Because if you look at the underlying fundamentals of Australia, they work very well for healthcare. Aging population, limited supply, growing population. It should be performing better than it is. So it's definitely one to watch. Now, as I mentioned before, we are seeing a lot of activity in that retail sector, particularly for the major regionals, the supers, and the regional sectors. So much so that last year we saw $4.5 billion worth of these assets trade, which is more than double than what we saw in 2023. And what that resulted in is actual yield compression, so value uplift for these centers. So this is transaction yields as opposed to valuation yields. And we've actually seen almost 30 basis points of compression last year, 3 consecutive quarters of transaction yield compression. So this is one of the better performing subclasses that we have actually in Australia. And it kind of makes sense because we did see a big correction in retail values as a result of COVID. And what this has now offered investors is pretty good relative value compared to how much they were priced a few years ago. And particularly good relative value compared to the other sectors as well. As I know, industrial is still running pretty hot. Now, a couple of things we're able to do with some of our products is we're able to decompose capital growth. Now, capital growth is generally driven by a whole heap of things, and we're actually able to split that out and look at what is really driving it. So on the left-hand side here, I've got the office sector. Now, that green bar, that's the impact of cap rate changes on overall valuations. And the blue bar is what I want you to focus on as well. That's the income component. So incomes remain pretty steady in offices. We haven't seen GFC style collapses of businesses, so they're still paying their rents. A building turns over about 25% every year, so it's a pretty solid and stable income stream. That's the beauty of property. But that cap rate change, that's what's really hurt that office sector. But if you look at industrial, it's a completely different story. What we've seen in the industrial sector is a heck of a lot of cap rate compression, which drove that value increase between sort of 2020 and 2021, 2022, which is that green bar. But if you look at the blue bar, that's the impact, that's the income impact, and that's driven by the extraordinarily strong rental growth that we've seen in the industrial sector. Now, so much so that it's actually almost completely offset that cap rate expansion. So total returns for industrial have remained positive. Yes, there has been a little bit of a value decline, but not a lot. And that's almost purely driven, well, it is purely driven by that income stream. So very positive news for the industrial sector. My only question now is, are we going to see that continued income growth in industrial? Rents have been growing at 15, 20, 25% in some markets, and that is simply not sustainable. It will slow down, and we are starting to see a bit more of a normalization for those rents. And I guess the question is, what is normalization for industrial? Is it back to the 1% growth we saw for about 20 years in Australia, or is it more the 3 to 4 to 5% growth? Because that'll really prop up those values. Now, nothing is propping up office values, I'm afraid. So what I'm showing here is it's just the capital value change for the major types of offices, comparing the GFC peak to trough to the previous peak or the latest peak to Q4. Now, what we're seeing here, of course, is a lot of value loss, pretty much across all market segments. And the only market that has not recorded more value loss compared to the GFC is Brisbane. It's about half of what we saw during the GFC. So that's the only office market that's doing relatively okay. But even then, it's still lost around 15% of its value. So quite a lot. Now, the problem with some of these office sectors here is mostly around secondary. Secondary offices have lost almost 30% of their value. And honestly, I can't see how that's going to recover anytime soon. The fundamentals just aren't there for secondary offices. You've got a lot of capex spend to bring up the ESG, bringing them up to the correct ESG criteria. Not a lot of tenants like secondary offices. There's constantly talking about flight to quality as people are getting better deals in those prime office locations. So they're moving out of secondary offices. So secondary office, I think, is going to continue to fall. And honestly, I cannot see where it's going to come back. Now, if we look at some of the other market specifics here, Sydney's getting the pace of Sydney decline is getting better. We only saw around 0.5% of value loss in Q4, so it's definitely on the turn. Melbourne, unfortunately, continues to see significant value loss. We saw around 1.5%, 2% in Q4 alone. And what that tends to mean is that we'll see another possibly 6 to 9 more months of value loss for the Melbourne office market, which is a bit of a concern. I'll go back to some positive stuff now. We've seen an awful lot of activity in the so-called alternative sectors. And I'm just showing a few of them here, and I'll pick out a couple of stories. So that big blue bar on the right in 24, that is data centers. The amount of investment in data centers globally is huge. And I think we saw another chunk of investment yesterday, future funds and CDC, I think, 16.5 billion, something like that. There's so much appetite for those data centers, and I can't see that slowing down anytime soon. Full disclosure, I don't fully understand how data centers work and how the technology works within them, but I do know that AI is certainly driving them, and cloud, machine learning, all that kind of stuff. And the appetite is just huge for data centers. I can't see that changing anytime soon. A couple other ones to pick out. Hospitals, healthcare, again, we're still seeing a lot of activity on the buy side, so I hope that'll start to prop up values. And the other interesting ones at the moment, of course, things like land lease communities. We're seeing a lot more of the major institutions pick up land lease communities or buy chunks of land and start to build land lease communities. We all know how difficult the Australian residential market is, so some of these corporate guys they're really tapping into that residential sector. And we're seeing that with the build to rent sector as well. Now, what I'm showing here is just build to rent construction start, so shovels in the ground. As great as so many people think build to rent is, it's not immune to the pressures that every other sector is facing. And one of those is the cost of construction, of course. Now, we had earmarked 2024 as being one of the largest years for projects to kick off, but several have actually pushed over into this year, and some have been sort of shelved for a couple of years, just because the cost of construction is so high. And a lot of these build-to-rent projects, they're on pretty skinny margins, pretty skinny returns. So if your construction costs jump up 30, 35%, those margins become even tighter and it might not make the project viable. So we have seen a few projects get delayed. We're also in the process of constructing a build-to-rent index, which we hope to release in and around May, and that'll give the market a first kind of indication on how these assets perform. So very much looking forward to that. So please do look out for that.
Just in terms of who's actually buying stuff, again, that big blue chunk there is Blackstone peaking over air trunk. It always messes with all of my charts. It's a bit of a pain. But if we do strip out that air trunk deal, volumes are pretty much the same as last year. Last year was a very low year. So we're still
Seeing, and I'm still hearing from investors that there's just better relative value overseas. Yes, our valuations have now adjusted quite significantly, but they still tell me that there's better relative value overseas, so they're looking overseas as opposed to coming to Australia. I'm hoping that'll change this year, given that valuations have certainly come off a fair bit over the last 18 months, and hopefully that then entices investors to get back into our market. A couple other pointers on here. Singapore has been our main source of capital for real estate over the last 25 years. But in the last 2 years, Singaporean investors have been extraordinarily quiet. And I put that down to the fact that they generally target offices in Australia. 80% of the capital they have deployed to Australia over that 25-year period has been to the office sector. And I think, well, from what I'm being told, certainly by them, the valuations didn't adjust enough for them to make acquisitions in Australia worthwhile. They could get better deals in Western Europe, the US, and the UK, so they went there. Now, I'm hoping that changes this year and we start to see a bit more activity because, like I said, there's a lot of product on the market out there for willing buyers. The other interesting one here is Japan. Japan tends to stay away from Australia for considerable amounts of time, and they come to Australia at the end of the cycle. There are many reasons for that. One of the main reasons, of course, is the cost of capital is so much cheaper in Japan that it makes these skinny returns that we see at the end of the cycle. It just makes them stack up a bit better. And I'm hoping this time around that Japanese capital is a bit stickier compared to previous cycles. And it seems to be the case because we have a much more developed sort of commercial residential market with land lease and purpose-built student accommodation and built to rent. It offers them attractive opportunities in sectors they really do like globally. So I'm hoping they'll stick around a bit longer this time. And if you combine 2023 volumes and 2024 volumes, that is more than the previous 25 years combined for Japanese investors. So they certainly are going big on Australia at the moment. We'll just see how long that lasts. In terms of where overseas buyers are actually, what they're picking up, again, the data center deal does mess up this chart. We stick it under industrial, so no surprise that 70% of capital allocation went to that industrial sector. But I think the more interesting points on here are those retail bars. Overseas investors have only allocated 8% of their total capital to Australia to retail, just 8%. Retail has offered extraordinarily good opportunities for investors in Australia, but overseas investors just don't like it. They don't get it. They don't want to manage it. Maybe it's just too hard to doing it from overseas. So that really hasn't changed throughout the 25 years we've been tracking that. But if you look at domestic capital, they're definitely piling into that retail space. The relative value there is pretty good. And domestic investors have been a bit more equal in their distribution to office, retail, and industrial, whereas overseas it's purely offshore, purely office and industrial. So it's almost like a captive market for domestic buyers if they want retail. But I do suspect we'll start to see a few more JVs in that retail space, such as Haben and Hines doing a partnership. I think that makes entry into this retail sector a little bit easier, and there's certainly good buying opportunities considering how much retail values corrected as a result of COVID. Now on to yields. There has been an awful lot of cap rate expansion in most core sectors, but we're starting to see again a little bit of a change there. A lot of this you can put down to just rounding errors, or it's just it's flat. But at this moment in the cycle, you kind of look for turning points. So being flat means it's arrested 2.5 years of cap rate expansion. So there are a lot more positive signs. One interesting one, of course, is bonds. And full disclosure, I haven't updated the bond chart after yesterday's interest rate cut. But I know a lot of people don't necessarily subscribe to the whole bond yield, property yield theory, but if you do, it's very tight right now. That is a very low risk-free rate, very tight, much, much tighter than the sort of 350 bips that we've seen over the last 7 or 8 years. So it'd be interesting to see what actually happens with property yields, because that is an extraordinarily tight gap. And if you do subscribe to the theory, either one of two things has to happen. Property yields have to skyrocket, or bond yields have to collapse.
Well, yourself?
Just looking at how many, we track around 168 property subsectors. And what I've done here is I've just compared 6-monthly cap rate change. Now, other than being an incredibly unfriendly printing chart, it does tell an interesting story. There's an awful lot of blue on the left-hand side of this chart, which is compression. So we saw yields compress for a very long time before COVID hit, and then we started to see some yield expansion. So flat for me is just a rounding error, 10 to 20 bips either side, up or down. We saw a lot of flat segments in and around COVID as values didn't move values. But over the last 12 months or so, there's an awful lot of green there, and that is cap rates expanding, i.e. value loss. So we saw a heck of a lot of cap rate expansion, and practically no sector saw any kind of compression. But in the latest figures, around 40% or even almost 50% of assets have been flat, and we have had around 10% of all our sectors see some yield compression. So again, good news. These are all positive signs. But I still find that too many people expected an extraordinarily sharp, strong bounce back. You're not going to see that. We're following a perfectly normal cycle here, and this is exactly how I would expect it to play out. Now, just to finish up quickly, we are an island, it's true, but what happens in the rest of the world does impact Australia. So what I'm showing here is just global transaction volumes. Orange means up compared to last year, blue means down. And there's an awful lot of both colours on this map. So many countries are moving at their own different paces, sectors are moving at their own different paces. And this is what I mean when I say that global investors look for better opportunities outside of Australia, because there's a lot of markets that are still struggling. Canada still struggling, China, some, Malaysia, Vietnam struggling, France struggling. So there's a lot better buying opportunities in some of these markets. So that's where global investors are headed as opposed to Australia. But there is positivity everywhere. This is just looking at our quarterly valuation indices across the world. Everybody's pretty much following the same kind of trend at the moment. Everyone's in recovery phase. Some are slightly ahead of others. The UK is certainly further ahead than Australia. We've seen positive capital growth there. We haven't quite seen any positive capital growth in Australia yet, but I suspect we'll see that in June. The US capital growth is pretty flat. But everyone's headed in that right direction, which I think is great news for the market as a whole. Everything I say, by the way, is purely caveated on as it stands today. There's a lot of stuff going on in the world that nobody can control, and it's very hard to foresee. But as things stand at the moment, everything looks pretty rosy. There's a couple other things that we're doing now at MSCI. We have a private capital solutions business, and what that allows me to do in research is look at things like how much is being raised, how much cash is being raised in that private credit space. There has been a lot of capital raised for closed-ended funds over the last few years, not so much last year. But what it tells me is that there's quite a lot of dry powder. There's quite a lot of capital that's waiting to be deployed, and that we aren't in a stage where nobody has any money to do anything. It's more that investors aren't willing to spend or to overpay basically for assets. They want those valuations to adjust, and once they adjust enough, they have capital at the ready to go and take advantage of some of these deals. And that's pretty much what I will expect to see this year. And it's very much what happened towards the end of last year, is that those that were well capitalized were able to act on pretty good buying opportunities. And I expect that to continue this year as well. Now, just some trends to watch from our global team. Full disclosure, I don't necessarily agree with all these, but I was told to put them in. Recovery not everywhere all at once. I more or less agree with this, but I'll change it to not everything. So I think each sector is going to move at its own pace, and it's going to be very, very asset specific as well. I don't think you can just throw a blanket on, say, premium offices and say they're great, buy a premium office, because it's very asset specific this time around. Investment drivers swing back to asset selection. Well, there you go. It is very asset specific, and I think there's going to be more. I think there'll be more deals done, but everyone's going to be quite circumspect about what they do, and it is going to come down to those asset fundamentals. We haven't seen a lot of distressed selling anywhere in the world. We track it very close in the US. Only around 15% of deals would be classified as distressed, compared to GFC, where it was well above 50. I do think we'll start to see a bit more distressed selling as owners look to recapitalize and pay down some debt. I do think we'll start to see a fair bit more of that as well. But I don't think it's going to be, we're not fire sailing or anything like that. This is an interesting one. Investors get to grips with physical climate risk. Now, we know in the US that terms like ESG are very much frowned upon these days, banned in some cases. But European investors, Asia Pacific investors as well, they still do pay attention to ESG. They still do pay attention to physical climate risk, and the private market is certainly driving some of these ESG criteria and mandates. So I don't think that's going to change with what's going on in the US. I think it's going to continue to become more and more important. Now, picks and shovels is an odd term for me, but I do agree with the sentiment here that investing in AI is going to grow considerably. I think there will be an explosion of development opportunities in Australia, but I also suspect that we're going to see a lot more M&A deals and entity deals in that data center space, because for that sector in particular, it's going to be easier to buy scale than to build scale. So I would expect to see an awful lot more activity in that data center space. And that's it for me. Sorry about the audio issues before. I hope everyone found that useful. And I think we're jumping into question time. So let me stop sharing my screen and invite Michelle to come back.
Thanks, Ben. We are heading into Q&A. If you do have any questions, please use the Q&A function at the bottom of the screen. It's just one point of clarification asked of you, Ben, and were these stats based on 10 million plus transactions or all transactions?
For all charts except the alternatives one, 10 million plus. For the alternative sectors, down to $1 million. This allows us to track things like childcare, which trade at sort of the 2s and 3 million. So all charts except the alternative ones are 10 million plus.
Okay, great. Thank you. Taylor, just for you, we do have participants from all around the country. Are there any big differences between economic outcomes across states, and are they going to continue?
Yeah, no, I think that certainly, it was a pretty bird's eye view that I kind of painted in that summary. I think when we look across states, certainly we can see in our business survey that conditions have been outperforming in the places you'd expect, in Perth, in Brisbane, to a lesser extent, Adelaide. You've seen, on the other hand, conditions in Melbourne have been a little bit below the national average. Sydney is somewhere in the middle. That's not something that, we expect to kind of reverse overnight. But certainly when we think about kind of what's driving that, I think, we shouldn't lose sight of how big the shock to population was back in 2020. And one of the kind of the stats that I like to point out is that Melbourne is about 3% smaller than it would have been if population growth continued at trend, whereas places like Adelaide, Brisbane, more than 3% bigger, Perth, more than 5% bigger. So that's not that long ago. We have seen differences in kind of housing price and asset price performance across states as well that have been kind of, a much bigger tailwind in some of these states that have seen some outperformance. And so when we look forward, we would expect some of these divergences to narrow when as things progress and as that shock fades further into the background.
I think Michelle has frozen, I believe. That's all right.
Let's see, are we going to get Michelle back?
We do have a question about Melbourne offices, so I'll just take that. I'll answer that. It's not my favorite topic, Melbourne offices. It is a bit of a struggle, and the question is around if we think the current trend of Melbourne office is going to continue for some time, i.e. negative growth, vacancy rate above 20%. So Melbourne's going through a bit of a double whammy at the moment. It over the last sort of 4 or 5 years, you've had almost over 600,000 square meters worth of office stock come into the market at a time when fewer people are going to the office sector. And obviously we're going through that structural change. So vacancy is extraordinarily high. It's running at around that 20%. In prime, it's a little better, but it's still double long-term averages. And it is the least occupied market within Australia. What I mean by that is occupancy rates are still quite low compared to Sydney, Brisbane, and Perth. And while getting people back to the office isn't the silver bullet for the office sector by any way, shape, or form, I think as more and more businesses encourage people to come back to the office, or indeed mandate it, which is always a questionable thing to do. But you will start to see an increase in office occupancy. It'll give investors a bit more confidence that the office sector is going to be rebound, and that'll of course mean that they'll start buying offices, and then that'll improve valuations. But I do think Melbourne's going to struggle for I do think it's going to struggle for a while. I don't think it's going to be a quick turnaround. I think valuation is going to continue to fall for the next 6 to 9 months, and the recovery profile, I think we can move away from, what the total loss is going to be. For me, that question is about that recovery profile. And given that incentives in that Melbourne office sector are still, they're high 40s and 50s, until they come down, the market is going to be pretty subdued. And I don't see them coming down for quite some time. So I think this is here to stay for Melbourne office, unfortunately, for the foreseeable future. And just to carry on a little bit, just a bit of context, it took office values 9 years to recover from the GFC losses. And that was during a pretty booming period for the global economy. I can't see how it's going to be any quicker than that this time around, particularly for Melbourne offices.
So Ben, as a follow-on from that, do you see many with office vacancy rates where they are? Do you see offices, converting to residential?
I don't, because I have yet to find an investor that can make the numbers stack up. It's very expensive to convert offices to residential. You need to knock them down, and we don't really like doing that. Things like embodied carbon discussions come into play, but I know some people think they can do it. I know some projects are around where they've tried. By and large, it's really hard to do. And I know CBRE claimed to do a global study where they said only 2% of office stock could possibly be converted to residential. I have no idea how accurate that number is, but I agree with the principle that it's an incredibly low number because it is extremely expensive to do, very hard to do. So I don't think that's going to, it's certainly not going to fix the residential market, and it's not going to fix the office market either. I just don't think the scale is possible.
Thanks, Ben. Everyone, I hope you found today's webinar interesting, and thank you so much to our presenters, Taylor and Ben, for sharing your insights. Their pack will be circulated afterwards so that you can watch it again and also see the presentation content. Thank you so much to our audience for dialing in. And for our customers on the line, I'd really like to take the opportunity to thank you for your custom. We appreciate your business and the relationships that we have with you. NAB is committed to working with our customers to finding solutions together. So please speak to your banker about your new opportunities and any needs you may have. And if you'd like to explore any interest rate strategies, we can put you in touch with our market specialists. You will receive a survey as the webinar closes. We do always appreciate your feedback and also any suggestions you may have for topics for our future quarterly webinars during 2025. I look forward to seeing you at our next webinar in May. So have a great day. Thank you and goodbye.